Hello, thank you so much for joining this webinar. It is on mortgages for the self-employed. Just to introduce myself, I am Sean Stewart. I am a mortgage broker. I personally don't like long webinars, so I've just kept this to 25 minutes. And at the end, I am going to give you a special offer. But before we start, I just want to make sure that we're in the right place. And so this webinar is for Canadian mortgages, so this is going to apply to anywhere in Canada. It's going to apply to anybody who is self-employed, whether you're a sole proprietor or a corporation or even a partnership. And it's also for anybody who might be planning on becoming self-employed. It's going to be a great webinar to really give you that education. It's for any type of transaction, so whether it's a purchase, refinance, renewal, or equity takeout. And it's also for anybody that works with self-employed. And examples might be an accountant, real estate agent, or financial advisors who typically work with a self-employed. Okay, so now that we've got a good understanding that we're in the right place and who this webinar is for, I thought I'd introduce myself a little further. I am a licensed accountant, and I've been an accountant for about 16 years now. I have owned other businesses. I've owned a franchise for 5 years, and now I'm a mortgage broker. And so I'm not currently practicing accounting, but all of this experience really helps me specialize in getting mortgages for the self-employed because I've been in those shoes. I understand the financial statements, and I understand how to present your business in the right light to the right lender that's going to get you the mortgage that you need. And this year, I actually published a book, and it's the book on mortgages, the Ultimate Home Financing Guide for the Self-Employed. And so this webinar is really just a summary of the book, and if you want more detail, absolutely, you're more than welcome to purchase this book. But hopefully this webinar is going to give you that information really quickly and get you up to speed. And so my story, back in 2012, when I owned the franchise, I did go and look to purchase my family home, and I just remember that feeling of just having no idea what I needed to qualify for, and I just took whatever I could get. And looking back, now that I'm a mortgage broker, looking back at just all the different lenders and options and solutions are there, I could have done so much better. Right? And so hopefully what this webinar is going to do, and my experience, is really going to give you a better mortgage product as a self-employed person and really teach you what you need to do to get that better product. And so the good news is there's so many lenders out there in the marketplace, and there are lenders that understand the self-employed. They understand your position. They understand whether you're a sole proprietor or a corporation, and they've got tools that help you. And people don't see this in the marketplace, right? And lenders have tools that can help boost your income, can really kind of capture what your true purchasing power is with your business income. They want to help you qualify, and they've got programs designed to help you qualify. And do not, settle for second best when it comes to interest rates. There's no reason as a self-employed person you can't get the best interest rates for what you're looking to do. And in the second part, what I want you to really understand is the self-employed niche. Okay, and we want to understand why are self-employed treated differently when qualifying for a mortgage. And it really comes down to our income. Okay, we've all been, self-employed. We know the ups and downs of revenues. One month might be really good. The next month may not be as good. Okay, so it adds a lot of variability in predicting what income we're going to be able to make and what income are we going to be able to use to qualify. Okay, and so it's a riskier type of income. And so lenders, how they mitigate that risk is they want to look at a 2-year history of your business, okay? And they're going to look at a 2-year average of your income, okay? And so by using this 2-year history and this 2-year average, that gives a lender comfort that, hey, over the last 2 years, you've made this kind of income. We think that's sufficient evidence that gives us comfort that says, hey, you're going to be able to make that kind of income or more in the future, and that's what we're going to use to qualify you for this mortgage, okay? And so a really simple example is, we're currently in the year 2020, so in 2018, let's say your income was $55,000, and then in 2019, your income was $64,000. Well, the 2-year average is $59,500. It's just adding those two numbers together divided by 2. That's the income that a lender is going to use as qualifying income for that mortgage, is that $59,500. And I've seen a lot of self-employed kind of get caught or not understand that this 2-year rule or this 2-year average rule is sort of the golden rule within mortgages. And so people will say, hey, in 2019, I paid myself $64,000. That's the income I want to use. Well, no, a lender doesn't want to use that. A lender wants more comfort in that. What is your 2-year history? So it's not $64,000 they're going to use. It's going to be $59,500. And in this section, I wanted to put in an explanation of interest rates. We want to understand interest rates because there's a lot of misunderstanding of what interest rates are available to the self-employed. And very simply, interest rates are calculated based on risk. And it doesn't matter what type of product or you're looking for, whether it's a car loan or a credit card or a mortgage. Calculation is going to be based on risk. And obviously, the higher the risk, the higher the interest rate, and the lower the risk, the lower the interest rate. And so what we want to do to get you the best interest rate is we want to manage those risk factors. We want to understand what those risk factors are. And we want to be able to present you in the best light or in the lowest risk so that you get the best interest rate. And so the next question is, what are those risk factors? And so very high level risk factors that lenders look at: income, credit, property, assets, other assets besides your properties like invested assets, and your debts, your liabilities. Okay, I'm going to go into detail in the section when we get to qualification, but just think of this is broadly what lenders are looking at in terms of assessing what your risk factor is, which is really going to influence what type of interest rate they're going to offer you. And so in section 4, we really want to understand mortgage lenders, okay? And in the marketplace, there's actually 3 broad categories of lenders that are in the mortgage industry. And so the first category is prime lenders. This includes banks, but there are a lot of other prime lenders that you don't even see in the marketplace. Alternative lenders is the next category of lenders, and then there's private lenders. And I'm going to go into detail in each one of these. Okay, so the first one is prime lender. And I think we all know prime lenders because we see the banks and we see the interest rates that are advertised. And so prime lenders are characterized by very tight qualifying criterias. They do require a low debt servicing ratio, and this is a ratio that lenders calculate, and it's really relative to your income, so your debt's relative to your income, and they want to make sure that that's a low ratio. You need to have a good credit score, and your income needs to be well documented in order for you to qualify with a prime lender. But this is going to be the best interest rate solution for you if you can meet those tight qualifying guidelines. The next one is alternative lenders. And the good news about alternative lenders is that it allows you for a higher debt servicing ratio, which means you can get more mortgage loan amount for the same amount of income. Okay? The negative side is that because it's a riskier proposition, because you're getting more loan amount for the same amount of income and the debt service ratio is higher, it's a little riskier. So it makes sense that the interest rate is going to be a little higher. Also, they might charge some small lender fees as well. Okay? Common reasons that self-employed find themselves in an alternative lender. And I'm looking at the blue box here in the middle. Common reasons: low credit score. Really, if you're in the low 600, certainly below 600 as a beacon score, you're going to be in an alternative lender solution. No prime lender is going to accept that. Also, high debt servicing. So even though people might have a good credit score, they might have good documented income, but just the loan amount that they're looking for is more than what their income can bear. So they need a higher debt servicing ratio solution, and that's why they find themselves in an alternative lender. Or you might be short on documentation in that maybe you haven't declared or you haven't well documented the income that you actually do receive, and so no prime lender is going to accept that, but alternative lenders will accept other documentation and give you the mortgage that you need. The strategy on the right-hand side, really I see an alternative lender is you probably want to be in a year, 2, maybe 3 years in an alternative solution, but you're looking to sort of fix whatever problems that's causing you to be in the alternative solution and put a strategy together to move you back into a prime solution. So it's sort of more of a short-term solution to get you back into a prime solution. And private lenders, I think we've all heard of many different stories of private lenders. The picture on the right is really the Wild West, because it very much is the Wild West, and you've got to be careful. There are some really good private lenders, but there's also some private lenders out there that are really more predatory. Okay, and even some big names. Don't just think you've seen some TV ad or something and that those are the best solutions. There's really good private lenders, and there's some private lenders that are just not really, in my opinion, not giving you sort of your best interests at heart. But anyway, case any private lender, it is going to be higher interest rate. There are going to be higher fees because the risk is much higher, right? They're not requiring you to have any debt service ratios. They're probably asking for little or no qualifying documents to prove that you can actually afford this. But you do need the equity in your house. Okay, so be careful, private lenders. Certainly, I know of a couple good private lenders that are actually going to give you solutions to help you out. Okay, probably the funnest section that we all want to talk about is qualification and how are we going to qualify as a self-employed. Now we've got a good foundation, we can start talking about that. And just as a reminder, what are the high-level things that a lender is going to look at? Income, credit, property, assets, and debts. Okay. And we'll go through each one of them one by one. And so the first one is income. And so we've talked about the 2-year average that we need to have. And so for a sole proprietor, we're really looking at your tax returns. And so what's the net income are you showing on your tax return for the last 2 years? And as a corporation, what is the salary that you're paying yourself on your personal tax return is really the first step that a lender is going to look at. And I'm really sort of focused a lot on prime solutions, prime lenders. This is the documents that they want to see. Certainly alternative lenders are going to be more flexible. Okay, and so what I want to highlight is really that rocket ship, is that boosting of income, okay? And really quickly on the right-hand side, lenders have tools, okay? They've got stated income programs to help you qualify. They've got gross up, you can gross up your income by 15%. Lenders will allow you to do that. There's certain deductions that you may have made on your tax returns that they'll allow you to add back. There's a cash flow analysis. Cash flow analysis is strictly an alternative solution. Prime lenders don't accept this. But a cash flow analysis is really take 6 months of your business bank account statements, add up all the deposits or the receipts, revenues. That's what you can use as your qualifying income. Or there's a percentage of corporate net income. This is fairly new. If you've left money in your corporation for 2 years and you've got a positive net income after taxes for 2 years left in your corporation, maybe we can use a percentage of that 2-year average from your corporation. So that's been a big help for incorporated self-employed. Next one is really know your credit, okay? And everybody, I think, understands that the better your credit score, the better, or the lower the risk, which means the better the interest rate. But understand, lenders are really going to look at just more than the credit score. They're really going to look at how many debts you've got, what are the balance of those debts, what are the payment amounts on the monthly basis for each of those debts. Certainly any bankruptcies or proposals that you've had, are going to be disclosed. Or any collections or history of late payment, we're going to need to explain the rationale behind that, okay? And so lenders really do a little more detailed digging on your credit report to understand you as a person and just your history with debt. Property types is really probably the most underestimated by most clients. People kind of think they've got a property, so give me a mortgage. But lenders really have a lot of different criteria for properties and the types of properties. And so really the location of the property is something that lenders look at. Urban versus rural. So are you on well and septic? Do you have acreage on your property? And so if you're a rural property, let's say you're sitting on 100 acres, lenders only look at the value of your house plus 5 acres. They're not going to use the value of all 100 acre. And so a lot of people have sort of come into that challenge thinking, hey, my property is worth $1.2 million and I'm sitting on 50 acres. Well, lenders don't see it. They don't see it as a $1.2 million property. They might only see it as a $800,000 property because that's the value of the house plus 5 acres. So be careful of that. Property type, whether it's a condo, detached, townhouse, etc. There's lots of different property types. Lenders look at that and may treat them differently. Property use, certainly lenders look at, is it your principal residence? Or are you renting that property? Is it a second home, like a cottage? And certainly lenders will have higher interest rates for rental properties simply because renters don't treat the property as well as you do as a homeowner, right? So when you go to look for a mortgage, you would expect to get a lower interest rate on a principal residence than you would on a rental property. And it's just purely because of the property use that lenders look at. Assets, this is certainly something that lenders like to see. If you can demonstrate that you've got a history that you have saved some money and over time you're able to put money away, like an RSP or TFSA or stocks or bonds or any kind of investments, as long as they're liquid, they should be ideally not locked in. But lenders like to see that, right? Because it goes to your character. It goes to show that you are able to put money away and you're able to manage money more responsibly. And some lenders actually have programs to help you qualify. Total net worth program. They'll look at liquid assets that are not locked in, at least $150,000 to qualify for this program. Some are more, some are higher at $250,000 minimum. But those programs can really help you qualify for the mortgage you need if you've got those assets. If you don't have the assets, but you do have a lot of equity in your property, there are some lenders that have equity programs at very good rates and will allow you to qualify really largely based on the equity in your property. And debts is sort of the final risk factor that we're looking at. You've got to include all of your other debts in your application. This is going to be confirmed by your credit report. They're going to, again, look at your credit report. The only thing that's not on your credit report is the alimony and child support payments. So lenders may ask for the separation agreement or divorce finalization, or they might ask for bank statements confirming whether you're receiving or paying out any of those amounts. And these debts really are going to impact your total debt servicing, which is really something that lenders look at. And we talked about previously, prime lenders have very low debt service ratios. And so if you've got a lot of debts, you may not qualify in a prime lender simply because your debt servicing ratio is just too high for prime lenders. And so where does all this leave you? You've got 5 different risk factors. We talked about all that stuff that they're looking at. And so I thought I'd put together some reasons, common reasons that I see people don't qualify. And so certainly debt servicing is too high. It's something we just talked about. For a self-employed, I've seen a lot of self-employed, maybe they've made $40,000 in 1 year, and then in the current year, they're like, hey, I'm going to pay myself a lot more money, maybe $80,000, because I want to renew my mortgage or I want to refinance my mortgage, and they think they're going to use that $80,000 1 year income that they paid themselves. Nope. As we've learned, it's a 2-year average, right? So if you've got $80,000 in the current year and then $40,000 in the previous year, well, it's a 2-year average, right? So yes, it's going to be $60,000 that they'll use, but it's not that $80,000 you thought it was going to be using. And so I've seen a lot of self-employed sort of be caught by this, right? Because they didn't know about the 2-year average. Property type and location is something we talked about in property. Keep in mind that prime lenders will lend pretty much anywhere in Canada. Alternative lenders, though, have very specific lending areas, and it'll go by postal code, and it's going to be really centric around large urban centers. And so if you're rural, if you're outside of these lending, even if you think you qualify for an alternative solution, if your property is outside their lending area, they're simply not going to give you a mortgage, right? And so you may thought you were going into an alternative solution, but really now you're going to be forced into a private solution simply because you're outside of their lending area. So keep that in mind. Down payment. There's lots of different programs and solutions, but some of those programs require a certain amount of down payment. And so you might be going in thinking, hey, I'm going to get this kind of mortgage or this kind of solution, but you don't have a down payment. Okay? And so what I always try to tell people, it's never too early to think ahead about your mortgage, certainly as self-employed, right? Because you needed 2 years. I don't mind if people call me 2 years in advance and say, hey, my mortgage is coming up for renewal, or I'm thinking of doing this maybe in 2 years. I want to make sure I'm on the right path, so I'm going to be able to qualify. Absolutely, we can talk 2 years in advance. Now, obviously, a lot of people may not be thinking 2 years in advance about their mortgage, but I'm just saying it's never too early to really talk about your mortgage, certainly as a self-employed person. Okay, and the final section of this webinar is the process, and this can be as critically important as learning how to qualify. Okay, and so really the first part of the process is we want to be able to tell your story, and certainly as a self-employed person, this is very important to a lender. Lenders always tell me or ask me, tell me the story. Okay, and what they're really looking for is, what type of business are you doing? Give some details, give some specifics. Why did you get into business? How long have you been in business, right? This is part of your story, okay? And so maybe you're a general contractor. That's not quite sufficient, okay? do you have some specialties? Do you have sort of a trend of the types of jobs do you do? Are you doing mostly basement renovations? Are you doing mostly kitchens? Or are you doing additions? That kind of, we need a little more detail, okay? Or you might be an IT person, right? And maybe you've started your business IT consulting and you've only been in business for 2 years. Okay, that's a little riskier than somebody that's been in IT for 20 years, right? So what did you do before you were an IT consultant? Oh, you worked in IT industry for 10 years. Okay, so really you've got 12 years of IT experience, but you've just gone out on your own in 2 years, right? That's the part of the story we want to be pulling out. Those are the things that are important because we want to be able to tell your story, okay? And really, documentation, I know everybody complains about the amount of documentation that we've got to put together, right? But documentation is really the language of lenders, okay? And so think of that. We want to present our story through documentation. So whatever we say in our story needs to be supported by that documentation. And think of it from the lender's standpoint. Okay, you're asking for a lot of money. They don't know you. You're a stranger to them. It's reasonable that they want a comfort level that you can afford this. Okay, and that to give them that comfort, it's through documentation. And the last point is accountants are your friends. Lenders want to see financial statements, tax returns, personal or corporate tax returns prepared by an accountant, a third-party provider, not an individual. So if you're not currently getting your tax stuff done by an accountant, I would strongly recommend that you start doing that when you go to qualify for a mortgage. Okay, and the last slide here in this section is choose the right lender. And this is so critically important because not all lenders are the same, okay? Lenders actually have specific borrower profiles. They're not just looking for anybody that wants money. They sit down and they think, who's the type of person we want to attract? And so there's certain lenders that say, hey, we want to attract the self-employed and we want to attract this certain type of self-employed person. And they'll put programs and they'll give best interest rates and good programs and tools to help you qualify because that's the type of borrower profile that they want to attract, right? So choosing the right lender, it's going to give you the best solution if you choose the lender that likes you the best. And I've seen certain situations where people have been declined at certain lenders. They come to me and they're like, I'm declined. I'm going to need an alternative or private solution. And when I find out their story, I find out their documentation, I'm like, look, you just went to the wrong lender. They just didn't like your borrower profile. Come over here to this prime lender that likes your profile and you're qualified and nothing's changed. It's literally you're just in front of the right lender that likes you the best. All right, the final section, take action. That's the end of the presentation. And really what I hope that you can do, I'm always happy to connect with people. If you go to the web page that you found the webinar on below, you will see the links to my Facebook, LinkedIn, Instagram. Certainly follow me, connect with me. Happy to connect with anyone. The special offer, again, is on the website where you've got the webinar. If you just scroll down a little bit, if you haven't already, you'll see a link to give you that quick reference guide. Okay, and that's my gift to you for watching this presentation. It's a 4-page document that you can download. It's going to go through some more detail in terms of how you can boost your income. It's going to give you a checklist of the documents you want to start putting together. It gives you a worksheet in terms of the numbers you can start filling in to start thinking about qualification. And finally, it gives you a list of the different costs you might want to think about budgeting. So please download that and you can use that to plan out your next mortgage. And what is the cost of a broker? A lot of people don't know what mortgage brokers charge. I'm absolutely free. I get paid a commission from prime lenders and alternative lenders once we close a file. So there's really no risk to you. The only thing is private lenders don't give me a commission. So I have to charge a fee, but I always put in reasonable fees, right? Private solutions should help you. They shouldn't be handcuffing you or making you in a worse position. So reasonable fees only on private deals. And that's it. I want to thank you so much for watching. I would love to connect. I'd love to talk to you. If you want to talk about your next mortgage solution, you can always call or text me at any time. Or there's actually a button again on that web page of book a call. So if you want my dedicated time for 30 minutes to talk about your file, please go ahead, book a time, and I will absolutely call you and we can talk about it. Again, no obligation, but I love helping self-employed talk about their mortgage, plan out their mortgage, and if we can do closed business, again, it doesn't cost you anything to do that business. I hope you found this helpful. Please tell anyone who you think may benefit from this webinar. They can sign up at any time. Thanks so much again, and have a great day.